Welcome to the latest episode of Death, Money, Taxes, and Law. This is the A team of Axiom Founders Family Office. Part of what we do here at our office is heavy duty tax planning. So we are constantly talking to our clients about tax planning throughout the year. Part of what we need to ensure, though, is that this tax planning is reported correctly on the tax return. So that's what we're going to talk about today, is what our thoughts are, what our ideas are as far as follow through on tax reporting and the documents you need to be thinking about. Joining me is my business partner, Armando Roman, who had formerly owned his own CPA tax practice. I've got several years working in some local tax practices, so I thought we would kind of start off with just a dialogue before I'll bring up our checklist, which we send out to all clients as far as what they need to be thinking about as far as documents to be bringing to their tax preparer. So Armando, I'll kind of pass it over to you, talk about any thoughts. In the meantime, I'll pull up our checklist.
Okay, good. Yeah, so Tom, tax time can be very stressful, lots of anxiety, lots of forms to get together and that. And it's interesting because taxes are a once a year thing for most people, where it's a mandatory federal requirement. So during that one time during the year when you think about your taxes, you have to remember what happened over the prior 12 months. And that's not always easy to do. So I always recommend having a folder where you put all your tax stuff throughout the year. And then when tax time rolls around, you've already got that folder there to remind you of what you did. Did you buy a house or sell a house or sell an investment property or make an investment? But all those things that you might forget about almost a year later can be super helpful when you have that folder where you can document and just have the stuff maybe even in a giant shoebox. It doesn't matter, but just some kind of a memory log. On our end over here, we use these checklists, of course, so that we can ask questions to jog a client's memory on things that might have happened. Maybe there was a new grandbaby and a new 529. That 529 might be a deductible, a tax deduction for this tax year. And, we did it almost 12 months ago. So then it's kind of, it's history because we seem to forget very quickly and move on to the next day very quickly as well. So the tax checklist here is basically a memory jog for, and as you said, Tommy, mail this out, email this out to clients so they can take a look at it as a way to remind them of things that may have happened that they might have just totally forgot all about.
Yeah, and that's part of our process is I was trying to help them. I mean, holy cow, Armando, you know as well as I do how much of an impact taxes have on our clients. I mean, it is unbelievable. It seems like it just kind of seeps into everything, whether it be any kind of income or any kind of activities in their business, etc. We're talking college planning, charitable planning. Taxes seems to be a part of almost everything. So one of the things we want to do is make sure that everything is reported correctly. So part of our process at our office is our clients, once they do meet with their tax preparers, sometimes we're even in the meetings, is we will ensure that all the tax planning that we did on the front end is reported correctly. Because man, oh man, I mean those tax returns, it's easy to miss something, right, Armando?
Yeah, and let me just make a clarification point here, Tom. We are not filing tax returns in our office. That is not what we do. We make sure that each of our clients has a tax CPA, I should say a qualified tax CPA. Sometimes we need to bring in a tax attorney if it's a gray area that needs that, that legal horsepower behind it. But we make sure all our clients have a tax CPA because the tax compliance is a whole specialty. And yes, I had a tax practice I sold almost 20 years ago in 2007. So I still remember a lot about those painful tax seasons. But that's given both you and I, Tom, a lot of experience of having done that ourselves, that it helps us help our clients as they prepare for their tax meetings. And we can also help interface and have that conversation with their tax CPA about areas that we might know about that they just totally didn't remember to talk to their tax CPA about. So we want to make sure that we're in those meetings at times to bring that up with the tax CPA so that it's clear what the client really did and what they were trying to get to, so that the tax reporting part of it, what's called tax compliance, that it's actually done correctly from the get-go.
Yeah. So our first section up here is income. That's part of the onboarding for when you come in as a client into our office is what kind of income are you getting? Our clients get anything from A to Z, so that's all taxed differently. So we want to make sure that, are you getting W-2 wages? Are you self-employed? Do you have taxable accounts that you see up here? Roth or retirement plans. It is amazing how many clients come in and they've got former 401ks or 403bs or this, that, and the other, SEPs or whatever, and they sometimes forget that they actually have these accounts, right, Armando?
Right. Yeah, because it's interesting. We spend a whole lifetime accumulating, and we do the same things in our home. So at some point, it's full. You forget what you did 20 years ago, or you forget about that company you used to work for 30 years ago, in that little 401k that's still hanging out there that you just kind of forget all about. So yeah, we do try to jog their memories and look at all the documents, of course, because a little thing can make an enormous difference going forward.
Yeah, and we know being in the business that most tax firms they send out an organizer. It's maybe 2 or 3 pages, and they expect the clients to know all these answers or how to fill it out completely. And some of this terminology, clients don't always fully understand. So,
Right.
unfortunately, in the tax preparation industry, sometimes the communication is not always, what it should be. So that's where we kind of make sure and ensure that everything's being reported correctly, or the right documents need to be grabbed from who or what or where. So.
Right, right. And so the checklist that you see on the screen, of course, is a checklist for us because we understand the lingo, we understand the acronyms, we understand those old tax code sections if we need them for whatever reason. We wouldn't expect a client to look at this list and understand it completely. But the point we try to constantly make is if you have a question, if you're not quite sure if the answer should be yes or no, that's when you reach out to us so that we can talk with you and make sure that it is clear and that it is handled correctly when it comes time to file those taxes.
So this is all the different types of income. Again, we're talking about, did you sell real estate or a home? Sometimes people they don't always think of certain transactions as being taxable. But yeah, if you gift to your family or and not always taxable, but should it be reported, to the IRS? Um,
Well, right. And there's a big misconception too, Tom, as you've seen, between tax credits and tax deductions. And credits are always more valuable because it's a dollar for dollar reduction of the actual tax bill. So, given the choice, if you can get a credit or a deduction, pretty much a credit, you're going to win by doing the credit versus the deduction. But if all you can get is the deduction, you know what? Take that too, or take that instead.
yeah. So here's the deductions over here. We can see that one of the things we always try to promote is saving efficiently, where there's different tax efficient retirement plans that are available. We always try to make sure that people are aware of what's available to them and what they're not allowed to contribute to. So you see some examples here. Most people know about the 401k, Roth, et cetera, HSA, 529s. Charitable planning, that's a big part. I mean, Uncle Sam's kind of friendly towards that. So if you did some charitable gifting, let's make sure that you're tracking that. Salt taxes, as we're looking at here, which is your state sales taxes, student loans, interest. Here's more deductions here. Here's the credits that Armando was mentioning. You always want to make sure you take advantage of those, as Armando mentioned. Anything you want to touch on here, Armando, or you want me to keep moving?
Keep moving through that, Tom.
Here's the other gifting. Maybe talk about that for a little bit, Armando. We have a lot of
Yeah,
that.
so gifting is something that people kind of forget about, and it's not an intentional forgetting. There is an annual gifting limit, and what the annual limit is, it's somewhere around $19,000. It changes a little bit each year, and it's probably on this checklist here. But anyhow, if you give up to that amount or below that amount, then you just make the gift, you write the check, give the cash, whatever, and you don't have to report anything. But if you give a gift over that amount, then you have to report it. And there's this what's called a lifetime exclusion. And that lifetime exclusion is an amount that everybody gets for their entire life. And whenever you go above that annual gifting limit, then that exclusion, you've used part of it. So that amount drops for your lifetime exclusion. It's all a little bit confusing, but just think about it like this. If you give someone an outright gift, write them a check, well, that's a gift. You guess to enter that threshold. If you help pay for your son's down payment on the house, well, that's a gift too. So just because you didn't maybe give them directly cash, it was still a gift and it needs to be reported. If you didn't report it because you didn't know, well, that's okay, but make sure to talk with your tax CPA about that. And then with them, come to a conclusion of either, yes, you're going to go back and file that gift tax return to make it right, or you're not because of some other circumstances that might be there. But our checklists are designed for us to, again, be that memory jog, because gifting is one thing that people commonly forget, and they just, or I should say, they just don't fully understand. So it doesn't get reported when it should be reported.
Yeah, and the tax preparers, they don't always do a good enough job asking the right questions to kind of find that information out.
Yeah. Yeah,
This
you
one
mentioned,
here, 529, 5-year averaging. I'm going to touch on a couple of tax planning opportunities. We have a lot of clients, mostly founders. All of a sudden, when they go to exit their business, they get a huge windfall. So what can we do to mitigate those taxes? Well, a lot of them really believe strongly in education. So a lot of our clients, we will often set up what you see here, a 529, which you can put a certain amount of money into every year. But this 5-year averaging, it allows you to put in a huge chunk in
that's
one
right.
year. So
That's right.
we
We're
will often set those up on the year of the exit of the business because now that goes against their taxable income.
right. There's an annual amount that you can put into the 529, but the grandparents will sometimes do this for their grandkids where they say, I want to write one check and be done with the funding. And so we have, one in process right now where one check will go into this 529 from one parent, and it'll be $95,000. That's the annual, or I should say the lifetime limit. So you can front load those 529s. And think about this, if 95,000 can go in from, say, dad, and another 95 can go in from mom, well, that's, what is that, $190,000?
Yep.
It's a lot. It's in one year. And for that little baby out there who's fortunate to have the wealthy parent and or grandparent, if they can in their first year get one lump sum of $190,000 into a 529, think of all the tax-free growth from birth to age 18 years of tax-free growth in compounding on those dollars. It can be tremendous. And if the kid never uses that money, that's okay. You can change the beneficiary to somebody else if they don't use it all. Really super powerful tool that is out there.
Yeah. So this one right here, do you own rental property? I mean, a lot of folks, they own rental property. So we want to make sure that you're documenting all those income and expenses and depreciation and everything. The IRS code is very favorable to that. So the IRS code loves business owners. So you see here, if you're an S corp, make sure that you're understanding that, hey, those tax returns for your partnership or S corp needs to be filed ahead of time because that's what's flowing through to the 1040. And then is that the right entity that your business should be? So part of your tax preparation or your communication with your CPA is, I own this business. Should it be an S corp? Should it be a partnership? Should it be a C corp? And then this retirement plan down here, solo 401k, kind of bounces off of that. So that's part of what me and Armando do is, we say, hey, what are you trying to accomplish? What goals do you have? Do you have employees, et cetera? And then we figure out what's the best retirement, what is the entity you should be choosing as a business owner. And then, as Armando said, we'll communicate that to their current CPA and say, hey, are we thinking the right direction? And let's all be on the same page here.
Yeah, and it really comes back to having an overall plan. So that's part of, as we plan with our clients and plan for them, we are developing an overall plan that includes taxes, asset protection, estate planning, and the investments in that going forward. But in that overall plan, one of those components is, of course, taxes and annual tax filing requirements. And it's important that we have that overall plan for that client, for that family, because think about it, the tax guy, the tax person is only in their own little focused, siloed discipline. They're just thinking about taxes. And in tax time, they are just bombarded with taxes, 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 and it's all got to get done in a really short time frame. So they're so focused, the tax folks are so focused on their little specific discipline that they might not step back and ask you all the questions that they should ask when they're doing that tax interview. And now, because there are just not enough tax CPAs out there and a lot more people who want them, a lot of people aren't even getting tax interviews when they come in for their tax prep. Instead, the tax CPA is just saying, hey, just upload the documents, fill out the organizer, and then we'll get your taxes done. Okay, well, if you're a really simple W-2 employee and you have nothing else, maybe that is fine for 99% of the situations. But as you said, Tom, for our clients, they've got businesses, they've got rental property, they've got complex things that are happening. They've got IRAs and Roth conversions and all these different things that come into the mix. So that upload your documents and fill out my organizer process doesn't work for our clients, and it probably doesn't work for most people. So it puts it on the taxpayer, on one going in to get the taxes done. It puts it on them to make sure to bring things up to the tax person, because tax person is so focused on those deadlines and due dates that they might not think about even asking the questions that they should.
Yep. Yeah, and we didn't even touch on one of your favorite retirement plans, which is the cash balance plan, or defined, along with a 401k and profit sharing feature. We've had some clients, we touch base with them. Maybe their prospects just coming on board. They had an incredible income year. We would bring up a cash balance plan, and sometimes that could be 200, 300, $400,000 in one
Right.
single year that becomes a deduction for that client, which is, I mean, it's a tremendous tool. But as Armando mentioned, a lot of these CPAs, they know they're kind of rear view thinking, or tax preparers, I should say. They're looking backwards, not looking forward.
Yeah.
That's where we ensure, hey, if we do set up that qualified plan, the tax documents, we know that there should be a 5,500, eventually coming down the pipeline. So we want to make sure that not only do we set up these plans and we help the clients get those investments going, but then also the compliance from a tax reporting perspective. We ensure our clients that that's done correctly, because the last people we want to get upset with our clients is the IRS, right, Armando?
That's right. Yeah, IRS can be very painful. So really, it's a whole team approach. Us as the wealth advisory firm focused on founders, we're part of the team. We often manage the team and run the team. You have to have that tax person on board. You have to have that business lawyer on board. When it comes time to sell the company, you have to have that merger and acquisition attorney on board as well. And attorneys all specialize. You have to have the right insurance agent on board for the business, for the home, for the cars, for the rental properties. So it's a whole team of people. And when there isn't someone like Tom, like you and I, who are helping to watch that overall team, then it puts it focused solely on that couple or the husband or on the wife, and they have to become the experts enough about insurance to really talk with their insurance agent to get the right coverage, and with the tax guy and with the business lawyer and with all these folks. So it puts a lot of responsibility on that family that's trying to just go forward and build wealth and protect it and do good things in this world, when they're not the experts in that space. But that's where we come in, where we can take that off their back, off their shoulders, and we can communicate directly with their experts, their advisory team, and then we take them out of the loop. And it ends up with a better result just all the way around, because then the client is really covered, and it helps to increase the odds, the probability that everything is in fact covered the way it really needs to be for that family at this time.
Well said, Armando. All right, well, that concludes our latest episode of Death, Taxes, Money, and Law. Thank you for joining us, and we'll see you next time.
Yep, thank you.